We are short Shopify. The problem with Fairfax for many years, it wasn't able to really produce a consistent or sustained return on equity. Bombardier, it's not the same position you were in 2 years ago. The balance sheet, you were never sure it was getting better or getting worse.
We speak with Sam LaBell of Veritas Asset Management. He's got a reputation for being brutally honest when it comes to Canadian stocks and isn't afraid to call it like he sees it, including on some cult favorites in Canada. Second year in a row of decline. What do you do with Constellation? You think gold stocks are undervalued?
I don't think the valuations of any of the companies have really caught up with the price of gold.
In your portfolio, are you making decisions based on tariff risk? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Fairfax and Constellation Software, which are both stocks I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We came through like 4 feet of snow to be here. So did our guest. So we're very grateful. And I'm sure maybe some of your joints are sore from shoveling mountains and mountains of snow. If you're in the Northeast, I know we have some fans south of the border. But sit back, relax. This episode is for you. We're going to discuss some fan favorites on the TSX. We've got Sam LaBell. He's a portfolio manager at Veritas Asset Management. And he's maybe got some hard truths for you around some cult favorites like Shopify, Constellation, and Fairfax. You might not agree with him, but you definitely can see that he does his homework and he gets into the weeds of the companies, but also the stocks and how the stocks will act. And of course, that's really important. We're also continuing to do our swag competition. We're getting great ideas. Remember, I'm trying to get all new swag put together for 2026. I've run out of ideas, so I reached out to you. You drop it in the comments wherever you're listening. Okay, so are you guys ready? This is what we have over the last week. I've got money coming out of my assets. I think that's funny. We need a laugh track. Let's work on that. Buy the dip, take a sip for a t-shirt.
But sorry, I just don't understand why that would be a t-shirt. It makes way more sense on a mug.
Producer Jillian says that should be a mug. That's why she's a producer. Okay, yes. Buy the dip, take a sip should be a mug. Buy the drip should definitely be a mug. This is for people who love technical analysis. A cup and handle chart pattern on a coffee mug. I like that. See, these are cerebral. And this one I really like from our friend Tim. Stocks are a girl's best friend. That goes nicely with my girls just want to have fun's mug. And stocks are a girl's best friend. Who needs diamonds? Actually, we all need diamonds. And maybe if some of these stock picks go well, we can have more. So let's get into it with Sam LaBell. Sam LaBell, thank you so much for joining me on the podcast.
Thanks for having me.
So should we just completely ignore the Trump post from the weekend threatening tariffs?
For sure. Why not?
I guess the question is, like, have we gotten to the point where we can ignore these sort of things? What are you doing as a money manager?
I mean, obviously Canada is dependent for our exports on the USMCA. In fact, we have probably the best deal of any, don't tell the Americans, but we have the best deal of anybody right now under the USMCA because most of our goods are exempt from all these crazy tariffs, except for specific sectors that the US has targeted, and we're still working to try to bring those tariffs down. So I don't know that our entire livelihood is dependent on the US, but we definitely we're an export-oriented economy. But when I think about it, most of what we export that is key to the US that's less likely to be attacked is commodities. These are commodities that have a global price setting. Mind you, North American prices have their own market and everything else, but the price of the natural gas we sell to the US is determined by coal prices and by demand for natural gas. Oil obviously has been a big focus with Venezuela, but we already have installed capacity for oil. You're really not going to you're not going to replace installed capacity with high fixed cost, high development cost oil that, yes, it's cheap on the margin, but it would take a lot of money to actually develop that Venezuelan oil. So I think we're in a very good place in terms of negotiating. What we do sell to the US is in demand. It's commodity driven. They're not likely to want to drive up input prices. That's a big thing. They're trying to combat inflation. Imagine if you start taxing potash, for example. Now suddenly your crop prices are going to go through the roof as farmers have to spend more on fertilizers. So it's like shooting yourself in the foot to tax some of the things that we actually do sell them that they need. And we do have alternative markets. You saw that deal on canola. And we need to do a little bit more of that, find ways to sell to other countries. But ultimately, yeah, it's kind of self-destructive for the U.S. to try to tax inputs to their wealth. And even the automotive industry. One of the reasons the Canadian automotive industry is so competitive is that we're kind of an outsourced version of what's going on in Michigan. And unfortunately, a lot of the population growth has moved away from the Northeast. So even without this latest kind of uncertainty around what's going to happen in automotive, the long-term future of the automotive industry in Canada was always kind of a little bit shaky because a lot of the population growth in the U.S. is happening in the southwest, and you have right-to-work states down there. And so it's become kind of a race for the biggest subsidy to build new plants. So Canada has done well competing just to preserve what we have, but it's hard to see that as necessarily a growth industry for us in the long term.
That's so much logic, Sam. Do we think that that's what's going to win out the day in 2026? And I ask that because if I were just to follow logic, that it doesn't really make sense for the U.S. to be this aggressive. Can I be that, I don't want to use the word complacent in my portfolio, but can I at least ignore the headlines this year? Understanding there's going to be volatility, but in all those industries, energy, potash, automotive, I can generally take comfort that I don't think that even if they cancel USMCA, I don't think that those worst case scenarios are going to emerge because it's just not logical to do so.
There's not a lot. It's just not an administration built on logic. I agree with you there. And some of the things that have come out are downright scary. At one point, then they couldn't figure out how they were going to get the dollars into their budget. They were talking about leaving the tax treaty that we have with them, which would affect dividends coming back into the country. Any Canadian company with U.S. holdings, how are they going to get their money back from those U.S. subsidiaries if you don't have a tax treaty? So that was very scary. But ultimately, again, we're pretty integrated with the U.S. economy. And I think the one saving grace here is that the U.S. is built on gridlock. In other words, you have several levels of government that have to fight it out, and they rarely agree. And rarely does one party have power over all of the branches of government. Right now, the Republicans do have a huge influence in the Supreme Court and in both houses of Congress. But we have midterms coming up in the fall, so it's another one of those cases where you have the early part of a term for president where you can do a lot, but if you don't get it done in time, if you're focused on things like Greenland, you're not getting the rest of your agenda through necessarily by the fall.
So bottom line, in your portfolio, are you making decisions based on tariff risk?
We do think about it, but I think ultimately we're looking for globalized companies that aren't just Canadian, aren't just exposed to the Canadian economy, because basically that's the growth in Canada is quite slow. And if you're going to slow your immigration, that's one of the key determinants of how fast an economy will grow is labor supply. And so as we age, which is something that both the US and Canada are facing, is an aging population, In fact, the demographics here in Canada are probably older than what you're seeing in the U.S. because they do have kind of a ground support of Hispanic population that's a little bit younger. So we're actually facing this aging population, and Quebec has recently actually had a population decline. So there's just, if you're not replacing the people, you actually have a risk of negative economic outcomes. And so Canada's not necessarily where you want to park all your money.
So I think that's interesting because it adds a layer, like demographics is never exciting to talk about.
No,
it doesn't sell on a podcast, but it is kind of that underlying factor that you can look at. You mentioned looking globally. I think that's a big question for investors in 2026. Are we done with the USA dominating performance? And should we be looking elsewhere now? And I'd love to get your perspective on that, like that you can own the world even if you're buying Canadian stocks.
Right, the so-called U.S. exceptionalism. They have a group of stocks that you can't get anywhere else, but I'll tell you what, those stocks are now bought up to such a level and so concentrated in the index that it becomes a global risk. If you own an ETF, you own a piece of NVIDIA, whether you wanted to or not. If you're trying to diversify by having a U.S. holding or even a global portfolio, if you have a global MSCI-based ETF, that will have a large allocation to U.S. large cap, and you'll own Apple, NVIDIA, Microsoft, and all the rest. So yes, I actually think that creates more of a risk, and it could actually slow the momentum of the U.S. stock market. Canada has the advantage that we're dealing in a lot of commodities. Gold's done phenomenally well in the last little while, and that's really supported by central bank buying, by a desire to diversify away from U.S. dollar holdings of the central banks. And it's worth saying that tacked onto that is a whole investment demand for gold. ETF inflows, they went from a period here where there were actually outflows from ETFs during the big craze for Bitcoin. Nobody wanted to touch gold. Now everybody wants gold. They all want gold ETFs. And so that investment demand has kind of accelerated the upswing in gold price.
Do you think that has legs?
I think it does have legs. It's sort of one of those cases where you watch it and you make sure that you're on side with it. But the second factor is that I don't think the valuations of any of the companies have really caught up with the price of gold. In other words, all of the producers are now in a situation where they're getting huge inflows of cash because gold price has gone up and their cost structure really hasn't changed. Margins have way expanded, and they don't have as many long-term projects on the go. So their CapEx as a percentage of revenue has actually declined as gold has increased. And so there's a big wide margin of free cash flow margin for these producers.
So still you think gold stocks are undervalued even with a huge rally?
Yes. I mean, this is, and you've got also some other products that are now spiking, like silver. So these prices feed into what the gold companies will make off their products. It's an interesting world of accounting coming from a shop that's kind of got an accounting angle. Is in the gold case, a lot of producers will actually take whatever they mine other than gold. They'll take that as a co-product and they'll use that to reduce their costs in some cases. So the cost they report will actually have these revenues for small fractions of other minerals that they extract.
So sorry, are they artificially lowering their costs?
It doesn't look like a revenue line. In some cases, when they report their all-in cost structure, it looks like a lower cost. So you can actually see some lowering of the cost base as they recover more co-product at a higher value. So one of the things we look for in a gold company is whether they're able to increase production over the next several years. A lot of companies have started to reinvest in things like copper and silver. These are commodities that are very well priced. And so as you look out a few years, that's a way that you can beat the market, even if prices are not increasing. If the production line is increasing, that's obviously good for cash flows and for results.
We're going to talk about specific ideas in the mailbag, but you brought up insight into how you approach stock picking, and you mentioned accounting. People will look at the name Veritas Asset Management and they'll think Veritas, the analyst, that is the sell side of the business where they rate stocks. And Veritas has a reputation, as you said, for accounting, for also putting sells on things, right? Like some of the other banks, they don't really do that. We don't have to get into it, but Veritas probably has the most sell ratings out there.
That's true.
Compared to some of the other analysts that cover it. And then there's asset management. So that business, the sell side where they
Yes.
research stocks and they put ratings on it, is different from what you do. Talk to me about the link and what's different at Veritas Asset Management.
So yeah, full disclosure, I used to work as the head of research at Veritas Investment Research. In fall of 2020, I came over to run our three funds. We have two in-house funds and one sub-advised fund. But yes, I've learned a lot about the difference between being a portfolio manager and being an analyst. Prior to being head of research, I was an oil and gas analyst for about 11 years during the whole Suncor build-out and Petro-Canada deal and Nexen deal and all these things when it was a very exciting sector. I think it's become a little bit more staid and predictable now. But the difference, I think, is that when you're an analyst, and especially our analysts, they're looking to go a mile deep in every company. They get into the financial notes. Our guys look at the accounting what accounting provisions have changed. How is it flowing through the income statement? What might they be doing to kind of juice the earnings or the cash flow statement? And they have the time to do that. I mean, when I look at the stocks that I look at, there's a universe of at least 300 stocks that we track at some level.
Mm-hmm.
And so you don't have the time necessarily to run full models on every stock. That's something that you do in the end stage when you're about to invest. So you're more focused on catalysts, on the story. And increasingly, I think you come to realize that, there's a big article, I think, in the Bloomberg Monthly about how stock picking has really become a lot more like gambling.
Yeah.
And not in a bad way, but in terms of setting odds and trying to exceed the odds. In the sense, I mean, obviously, if you're going to bet against the house in sports betting, the house is against you. In stock picking, the house is actually for you because stocks do go up over time. So that should be reassuring. But what you're trying to do is you're trying to avoid the situations, and there's probably 25% of names in a given year where if you were in those names, it can be lethal to your portfolio because they'll post a 10% or 20% loss. So how do you avoid those losses while still picking things that are going to perform for the long run? And a lot of that comes down to what the market is thinking is going to happen versus what is actually going to happen. The market is really good at pricing in very specific, very definite information. It's not good at pricing in things where you might have to think about it and set odds, and it really can't do that in a meaningful way.
So is that the key difference from buy side and sell side? Like sell side, there can be nothing wrong in their research, but that's just not what the market's going off of.
Well, they'll set the discussion. And they'll be, when we talk to our clients, what do they look for? They look for one analyst who's bullish, one analyst who's bearish. That's a little harder to find, but we obviously fill a nice niche at Veritas. And then they look at somebody who's really good at predicting the numbers, like modeling EPS and getting the right line items into the model to get the right EPS figure. So they pick out those three kind of distinct analysts to try to fill in their need to pick things. They want to buy something and have all the reasons that they're buying it be clear, but not necessarily understood by the market. If every bullish argument you have on a stock is already understood by the market and priced in, it's very hard to do well.
Do you go long and short in the fund?
We have two funds. So we have two in-house funds. One is a long Canadian equity fund, which also has the ability to buy some U.S. names. And then we have a long short fund, which is an absolute return strategy. So that involves you'll be net less than 100%, usually 60 to 90% after deducting your short positions from your long positions.
Are you shorting because you're hedging, or are you shorting because you have conviction the stock goes down?
So the idea of a long short product gets pretty complicated, but basically everybody has enough equity exposure. We're all 100% long equity because bonds don't pay very well. So that creates a lot of risk because when the markets do go south, all the markets tend to move together and you have no hedging. It used to be that you could go to emerging markets or you could go to Japan or Europe as a way of hedging out your domestic exposure. But because all the markets now are so correlated, it's very hard to hedge. So a long-short portfolio, the idea here is that some of the strategies in the portfolio are not correlated with equity. Mm-hmm. So shorting obviously is not correlated. It's the opposite correlation to equities, hopefully, if you do it right. And there's also the ability to write options, which earns income. That tends to be not correlated with the market. So we're designing the portfolio there with a combination of shorts that match our long book and options so that the correlation is somewhere short of 40%. And then when the market goes down, we're set up to gain from various strategies that will pay off.
So it's like a risk management. It's not like, because Veritas does bring up like accounting issues, you're not short. It's not like they would call it the activist shorting.
Yeah, we're not activist shorting. We're not getting into stocks to call them out to make them go down. In fact, those stocks tend to be very risky shorts.
Tell me why.
Well, effectively, a stock will go down if something bad happens, but it'll go down 20%. And then somebody will say, well, it's not as bad as you think. And then it will pop 15%. So you can get into a situation where you get more volatility out of these stocks that are in the eye of the storm. What we're looking for is to build a portfolio of about 20 to 30 names short that will just underperform the market. Because what happens when I short, I get cash back. I can invest that cash, or I can earn interest on the cash. And so that's beneficial. And those short positions will tend to have a negative correlation against our long positions. So we think of it in terms of a long-short spread. We're never going to be 100% short. We'll be, 30 to 50% short. And that's matched against the long book. So we need our shorts to underperform the index. That would be great. We need our shorts to underperform our long book. And if those two things happen, we'll make a nice spread between long and shorts. That's the source of the return. So looking for things that go to zero, that you could spend a long time trying to find those single stocks. And there are businesses that are aggressively short that way, where they take a 5 or 10% position and then go out and publicize it. We're not in that bucket. We're probably, our biggest short position would be somewhere around 2%. So
we have so many questions in the mailbag.
Okay.
Let's get into that. But first, let's take a look at our ETF Minute. This ETF Minute is sponsored by BMO ETFs. This is for general informational purposes only and not personalized investment advice. Looking for growth in your portfolio but unsure which growth stock could be a winner? Well, the answer to uncertainty is diversity. Enter the BMO Growth ETF. It takes the guesswork out of allocation. You'll get 80% exposure to stocks through various BMO ETFs and a buffer for volatile times with a 20% allocation to fixed income. It's a low-cost way to invest globally with a growth tilt without having to bet on a single horse. Now, the ETF recently hit an all-time high, and even though it's tilted towards growth, it doesn't go crazy with tech exposure. Tech is the biggest sector weight, but at less than 20%, it is lower than just owning the S&P 500. Furthermore, you get exposure to growth sectors like banking and mining. And as an added bonus, BMO ETFs recently lowered their management fee to just 0.15%. For more information, go to bmoetfs.com. Okay, our first question is on Barrick Mining. Barrick had a great year in 2025. What are your expectations for 2026? That's the question that we have. It had a great year, I guess, but a lot of major changes towards the end of last year. CEO Mark Bristow suddenly out, an activist present, spinning off their Nevada assets into its own IPO. And all of that helped Barrick start to outperform.
Yeah, Barrick is one of those companies that kind of got in the penalty box with institutional managers, and that's hard to get out of. You're looking for some evidence that they're taking some of the concerns of the investor community seriously. And the question is Barrick worth more as kind of a global integrated miner with lower risk assets tied in with higher risk assets, or is it worth more if we split out the lower risk assets and then split out the riskier kind of overseas assets? I do think that there is a premium that they can achieve by splitting some of those assets off. It does make for a little bit riskier company, though. There's something to be aware of, is that if you bought Barrick because it was a lower risk company and then they spin off all of the North American and lower risk assets, now you own something that's a lot riskier. So it's worth hanging in for. In fact, we're investing in it. We think the activists, there was a study done many years ago about activist investing, and they said that typically just the announcement of an activist can jump the stock 3 to 5%, and that 3 to 5% tends to hold up. but not necessarily exceed the original 3 to 5% that on the initial boost. So statistically, some of these activist stories work out, some of them don't. On average, the gain that you made early on, that's the gain that you're likely to make.
This one is different, though.
I think there's still room here for them to finish the job and to get the markets kind of aligned with. I mean, the markets like pure plays. They don't like to split between two stories. If you can give me a pure play copper company when copper's running, then the market likes that a lot better than trying to pick out the copper from another company. In terms of the growth profile, Barrick does have some copper growth, which is something that we like as well.
It's up 240% since the beginning of January last year. That's way more than bullion. You can say that about a lot of gold miners. Yes. How do you make sense of that and say you can keep adding here?
So we tend to look at these things in terms of their EV/EBITDA multiple. So what do you pick?
Enterprise value.
Yeah, enterprise value. So the whole company, including debt. So that normalizes across different companies that might have more or less debt in their structure. So if I was to go buy this whole company, what would I pay? That's enterprise value. And then compare that to something that just reflects the money that you make before you pay off debt and equity. That's EBITDA. So before earnings, taxes, depreciation. So when you look at that multiple, it's risen. It's up to, if I average the ones that we own, it's about 6.7 times forward EV/EBITDA, up from 6 a few years ago. That's not terribly expensive. And I would say that it doesn't reflect yet the full benefit of the rise in the commodity price. With gold pushing towards $500 or $5,000 an ounce, that's not necessarily priced in yet in people's forecasts. There was an inflection point over the last couple of years where revenues kept rising and rising and rising, but the amount of spending that companies are putting in, that they're putting back in to reinvest on the CapEx side, that's actually declining as a percentage of revenue. And so you have this widening margin of free cash. EBITDA margins are way up. There's still some taxes and other things to pay before you have free cash flow, but CapEx is down. So this widening margin is something that Barrick and many others are facing this year. And what do you do with the cash flow? Well, once you've paid down debt, then you start buying back shares. These are all great things for investor returns.
There is some reporting that Barrick's ability to spin off its Nevada assets actually need the approval of its rival Newmont, in which they co-own the assets. Do you think that could hold them up?
Well, there's a price. I always say there's a price for everything, and there probably will be a price there that they'll have to figure out. And maybe it may even be that their partner will be one to buy out some of the assets in a deal that they spin off. But they do have to obviously consult with partners before they can do.
So you own Barrick?
We do.
And what are some of your other favorite golds?
Hud Bay Minerals.
Is that a gold?
It's got some. It's got some, but it's a copper. Yeah. It's not necessarily goal oriented, but it's definitely a growth company. Done very well. They've had to sort of sort through some things that are happening in Peru. But ultimately, it's one of the we like to mix in a little bit more growthier names with more stability. Agnico Eagle we've owned. It starts to get a bit pricey. It's priced because it's so certain and has so low geopolitical risk. It tends to get a premium. So the question is, are you getting enough premium, and is there enough there? And we do like it. But as the year kind of progressed, we circulated some of our gains in Agnico into Barrick, into Newmont, another name that we own.
How do we think about owning these stocks if bullion either stops going up, if it falls, if it doesn't grow at the same pace that it has been growing? Like, what kind of risk is there?
So when we look at what's the source of this run, because that's an important question, we think that obviously central banks at a certain point decided that they were going to slow their purchases of U.S. treasuries given all of the deficits that they're running and some of the geopolitical conflict. All this tariff talk doesn't help. So the biggest buyers of U.S. treasuries, Japan and China, stopped buying. Probably since 2019, no net increases. They've been letting a lot of it roll off. Instead, they've been diversifying into gold. And a lot of other countries have looked at gold as a relatively safe asset in the event of sanctions or perhaps to get around sanctions. So central bank buying was the first plank. And then on top of that restricted how much supply was available as they started to ramp up their buying. But I would say that particular category hasn't been growing. It's been steady. So at increasing gold prices, the volume of gold being bought by central banks is the same each year, but they're not ramping up how much gold they're buying. So they're quite happy to just let gold run and buy at a steady rate. But on top of that, we've had an inflow into ETFs. So ETF demand is the leg that's really caused the parabolic move up, in my view. When you see ETFs flowing in to gold ETFs, you tend to get this big rapid increase in gold prices. When they flow out of ETFs, you can have a headwind, and the opposite can be true. So that is our risk, is that the desire for gold is quite high. And certainly I think there's been a diversion maybe away from Bitcoin. When Bitcoin was doing very well, gold ETFs couldn't get a bid, and there were outflows. But now the Bitcoin's kind of become less, Bitcoin and other cryptos have become less interesting. Now maybe I do want some gold, and it's become fashionable to say it should be a core piece of your portfolio. That's good for gold as people rotate in, make it 5 or 10% of your portfolio. But ultimately, and we have a slide in one of our decks that shows how far has the gold price run. If you look at the ratio of gold to GDP in 1970, it ran up to about 700% of that ratio in the early 80s. And we're at about 500%.
That still feels high.
Yeah, so that's unprecedented. Other than the 1982 rally, the rally through 1982, it's unprecedented. So the problem is when it does peak out, it tends to drop 20 or 30% in the following 2 years. So it is risky. It always was risky, but it should be a piece of your portfolio, but you should keep an eye on it.
The Bitcoin versus gold, I think, is like that. This is a big victory lap for the boomers who said, it's still gold. It's still gold. Yeah. And it proved out it is still gold. Okay, let's move on. Bombardier is one of our other questions. I'm considering buying shares of Bombardier. This coming from Paul, but have I missed the rally? I mean, the stock has tripled over the last year. I've counted 2 downgrades, one from Scotia. Goldman just cut it to sell. Most seem to say it's on valuation. The Goldman downgrade said actually the business isn't growing as fast as peers. Sales are going to slow. And when you have a big rally, that's a high bar. What do you say?
So obviously we've done very well on Bombardier. We owned it since the spin-off of the train division. At that time, nobody wanted to touch the thing, and there was some question about whether they'd get sued for some of the legacy liabilities from the train deal. And so we liked the idea of a pure play jet company. We thought that would really focus the attention of the market and that they could start to build their backlog and improve their free cash flows. They did that. Now they've got a spectacular backlog. They've got great free cash flow. But yes, where is the next leg of growth coming from? They are starting to get into some defense orders. That's something that people are looking at. And they're building out the aftermarket servicing division. That's an important piece because it does contribute margin as you go forward. And that one is sort of a steady build out. So it's become a steadier company. The multiple has come up. It's more in line with peers than it had been. But there's still a little bit of room to grow there. So as we look at Bombardier, it's not the same position you were in 2 years ago, where it's likely to lift some of the clouds that were surrounding it, because I think a lot of people now view it as a relatively predictable company rather than, oh, are they going to make cash flows this quarter? We're not sure. And that's where the discount for Bombardier always sat, is that the balance sheet, you were never sure it was getting better or getting worse.
Do you think there's still people who don't touch Bombardier, or has it fully ingratiated itself back into the hearts of institutional fund managers?
I think people will avoid airline stocks and airline-related stocks just on principle. So I think there's probably many people who got burned by Bombardier. I mean, Veritas has a long history on the research side of covering Bombardier and calling them out. So we were kind of... it
was a big deal. It
was a big deal that we put a buy on Bombardier at one point. I don't think it's such a big deal anymore because we've been following it through. But we still like it. It's still part of the portfolio, and we have trimmed back a little bit because it grew so much that we trimmed back our position a little bit.
Okay, so that's interesting. Going against kind of sell-side momentum, which seems to be downgrading or cutting on Bombardier. So that flows nicely into our next question, which is about Fairfax Financial. It has also recently come under pressure. There was a downgrade from an analyst, I believe it was at Bank of Montreal, but basically saying global insurance and the reinsurance market is softening. Fairfax, which has done tremendously well, Canada's Berkshire, it's outperformed Berkshire. It could be faced with declining underwriting incomes. And then just generally, maybe the investment gain outlook isn't as robust as it was last year. So, for an insurance business, they need insurance premiums and they also need good markets.
Yes.
And BMO basically calling into question both of those things.
Yeah. So one of the things to think about in financials is that all of the financials, whether it's a big money center bank, a regional bank, or an insurer, they have to get a return on their equity. They got a return on the book capital. Because the book capital is regulated, there's a regulator standing behind them saying this is how much you can lend or this is how much you can grow assets without having bonds on the side to defend yourself in the case of an insurer. So that is what really drives the valuation is the ROE.
I'd like to define these things.
Return on equity.
Return on equity for every dollar that you've invested. This is the amount of profit they can make off of that.
Yeah, and effectively, it's not what you're paying for the stock, that's market cap, but it's what's on the books as equity. And so earnings divided by what's on the books as equity is return on equity. So if earnings go up, obviously, good return on equity. So the problem with Fairfax for many years is that it wasn't able to really produce a consistent or sustained return on equity. If you look at the 10 years leading up to the pandemic, so kind of 2010 to 2009, or 2019 rather, there were about 4 years where they had negative ROEs. There was 4 years below 10%. There was 3 good years where they had above 15%. But then post-pandemic, suddenly premiums in the insurance space started to become healthy again, owing to people's perception of risk and a willingness to hedge risk. Because what Fairfax does in large part is it insures some trickier to insure businesses, so property and casualty, but also reinsurance. They have Odyssey Ray Reinsurance, Odyssey Ray. And what they do is they take the tail risk for other insurers who don't want to take catastrophic risk on the tail. So obviously that was a nice fat premium market for a few years post-pandemic. And suddenly you have Fairfax earning over 20% ROEs for 21, 22, 23, drop back again to 16, 17% and on pace for maybe 18%. So the thing is, when you look at how the market is valuing insurers, and this is where it gets a bit technical, but bear with me, is that
sticking with you.
If you take all of the financials in the market, in North American market, and you graph them on a line where you're plotting return on equity against price to book. So price to book is what you're paying for that book value that they have on the books. Return on equity is kind of the return you're making each year. There's a very solid line, a trend line that has a relationship between ROE and price to book. It's not surprising. What I'm willing to pay is tied to their ROE. So the trick here is that when a company beats on earnings and beats on ROE, it tends to move up that trend line and earn itself a higher price to book multiple. So you're really, again, you're trying to figure out, am I paying 15% ROEs or I'm paying for 13% ROEs or 12? And when we looked at Fairfax last year, we could see very clearly that they were priced for sub 15% ROEs with a trend line for earnings and for ROEs that looked pretty healthy. And it was a good buy. So we bought some last year. We held it. It ran up through $2,500. And then as we look forward, again, always looking forward, we're starting to see that this insurance premium market that they're in is a bit softer. You might start to come into some losses on underwriting that was written the last couple of years. Peers, their valuation multiples are coming down. And the ROE now may not be as certain to exceed 15%. But we're paying now probably for better than 15%. So that's where we decided to take our profits and exit. But it's not to say that it's not a good business. It's not to say that they could potentially beat on expectations. Yeah. But as we look at it and we think about where our skills are in projecting what might happen at Fairfax, we think that it's probably a riskier stock than it was last year, and potentially it could disappoint ROE in the next year or two. And there's pressure on peer multiples. So it's kind of, that's how we made our decision to exit. And also we'd made
it's too expensive for what you'll be getting.
Yeah. And we'd made a very good profit, and it's not in the dented can bin. It's kind of fully priced.
Okay, that was a long walk, but I'm glad I hope everybody stuck with that because that was really great insight. Let's see if we can apply it to Constellation Software, which I think last I checked is the worst performing stock of 2026. I know we're less than a month in. Okay, now it's only the fourth worst performing stock on the TSX, but you used to be able to bet the farm on Constellation going up every year, and now it's looking for a second year in a row of declines. Yes. What do you do with Constellation?
So we exited our positions in Constellation last year.
Why?
I'll go through kind of what's going on with Constellation and how to think about the business, because it is a numbers game always. This is a stock that always trades at a elevated multiple. Why does it get the elevated multiple that it does? So when it comes down to it, Constellation's known as kind of a platform. We used to call them roll-ups, but apparently that's not a positive thing to call a company anymore. But they go and they acquire other businesses at a discount. So usually private businesses tend to trade at a discount to public businesses. And they buy them, they put them into a portfolio of software companies. They call them vertical software companies. So the software that runs your gym memberships, or they're very esoteric type of software, but it's tied in with the person's business. And therefore, it becomes kind of mission critical to them. As long as the prices don't go up too much, they're not looking for a solution to replace it. A lot of these software platforms have been around for 10, 15 years, and the entire business is integrated into it. So that's the strategy. You buy something cheap that's private, come in, get a public valuation on it. It's a portfolio of these smaller companies, so that reduces risk overall. And that always worked for Constellation. And I'll go through the numbers of how does that work. So Constellation, if you look at their Q3 run rate for free cash, so how much cash comes to the bottom line from the existing businesses, forget the ones they're about to acquire, but the ones they already own. They were making about $2.7 billion US in free cash flow. Okay, so typically for a mature business, it's not growing or might be growing at 3%, a little bit above inflation. You don't pay much more than a 14 times multiple to free cash. And that's just the mechanics of how discounted cash flow works and all that stuff. But 14 times free cash is a good rule of thumb for a mature business growing at 3%. So if we take 14 times that 2.7 billion, that gets you to about 38 billion US for the base business. Okay, the company is trading at 43 billion US as a market cap. So they need a piece here for acquisitions. How do we think about the acquisitions? Well, they typically take about 80% of that free cash flow and go out and buy other companies with it. So that 80% of 2.7 billion free, they've got 2 billion to go out and spend. They buy these things cheap and they're worth more after they buy them. So what we call that is acquisition arbitrage. You're buying something for less than what's worth after you take possession of it. So let's say they can make 50%. They can increase the value of what they buy by 50%. So the thing that they buy for 2 billion is worth 3 billion. They've created $1 billion of value for you, the shareholder, that you can take in pocket. And if they can do that every year and keep that growing at 3%, then you would put a 14 times multiple on that 1 billion of free cash flow generation. 14 times 1 billion, 14 billion. Add that to the base business, which I already described as a $38 billion business. 38 plus 14 gets you to $52 billion fair value for something trading at 43 billion. These are the nerdy things that I do at my desk.
No, let's do it.
All right. So the problem is that maybe with AI, we have a threat here. Maybe the ramparts are being stormed here and a vertical software business can be replaced at relatively cheap costs, because the biggest difficulty in software is it has high fixed upfront costs for programming. And then rollout, you have all of the uptake and user experience that you tweak to make a great product. And then the product's there and then it just amortizes forever. So that fixed upfront cost has been lowered by AI because people can program very cheaply using AI in theory. So that competition may mean that a number of things may happen. It may mean that some of your businesses are now under threat from alternative products that have been quickly developed. Somebody sees an opportunity to program something and take over your business. And maybe that 3% kind of assumed growth rate is no longer 3%. Maybe it's 2% erosion in your base businesses because software, on-premise software is being replaced by cloud. It's being replaced by AI service type solution. Not as much, but that's coming. So that 2% erosion, that would drop the multiples that we did everything on. We did 14 times on both sides, and that's kind of a shortcut, but 14 times both sides. If they're eroding, you're not paying more than 11 times for something that's eroding at 2%. And so 11 times, do the same math. Now you have a $42 billion company trading at $43 billion. So the real question, and this is kind of an existential question that even Mark Leonard in his farewell press conference, he said, I'm not sure. I mean, I love Mark Leonard because he's probably the most honest CEO that's out there. But what other CEO would say, I'm not sure? They'd come up with something that sounded good, but what to his point is either going to make it much easier for us to buy things and use AI to kind of improve them very quickly, right? We can buy something that's substandard and use some AI programming tools that lowers our cost of improving the product right off the gate. And then maybe add some more features with the AI that could grow the business. Or it's going to mean that we're going to face a lot more competition, and maybe the businesses that we're trying to buy become less valuable in our hands or after we acquired them.
And then we could maybe give a little bit of credibility to Mark Leonard to figure it out, except that he's no longer in charge. He stepped aside for personal health reasons. So this existential crisis that he's not sure about, he's also not there to handle.
Yeah, I mean, I'm not necessarily, I mean, you see in some companies that there's kind of the great man theory of corporate management, that it takes one great man at the top and that's what runs all businesses. But in reality, really successful public companies don't just have one person at the top. They have a whole team of people. And one thing that Mark Leonard has done over the years is he's decentralized a lot of the decision-making to individual units and to individual unit heads. He was kind of, yes, he was at the top as making kind of the glue that brought all these people together. But all those people are good at making acquisitions, good at sourcing acquisitions. That doesn't go away because you lost one person at the top.
So it sounds like if you want to know whether you should buy Constellation Software, like a multi-year low, which is not an opportunity that you've had, I don't know, ever, since Constellation has been public, you need to be able to answer that existential question.
Right.
We're not going to be able to answer it next quarter.
No.
You're not going to be able to, like, when do you think?
That's why we're out of the stock, essentially. Okay. We can't put we don't know. And then again, this comes down to my numbers on paper. That's maybe not how the investor base is thinking about it, because a lot of people invest off of storylines. And so it's tough to come up with a definitive storyline or an ending to this story because we don't know for sure. I will say that we track every quarter that Constellation reports. We track what their organic growth rate has been, and there's no seeming erosion. In fact, there was some similar worries during the pandemic of what would happen to all of these underlying software businesses, but they earned through that.
So can I be clear about what you're saying, that the risk of what people are afraid of, that they will not be able to buy companies and increase the value, that has not yet shown up in any of the results?
Yeah, I don't think that's the risk. And in fact, maybe it becomes easier to buy things because the company that you're trying to buy is also worried about competition from other people, and they've built a franchise, and they're worried that, well, how long are we going to be able to maintain this valuation? So it creates a bit of chaos in the software industry. And I think, if we talk about other companies in software space, the market has divided them into winners from AI and losers from AI. For a while there, everyone thought Thomson Reuters was going to be a winner from AI because all they needed to do was roll out some AI-oriented products. They had the customer base. They had the natural market to sell it into. Oh, no problem. But one of the things that I came across, and maybe I shouldn't say this about Bloomberg, but Bloomberg is trying to up its AI game and is trying to develop an in-house AI program.
I'm waiting.
Did they come in? Did they trial it for you? Because they came in to show us this AI product.
Was it terrible?
And we asked it, how many phones did Apple sell last quarter? And they put it in, and it's querying. I walked around the table. I won't name the service. I went to another AI platform. I typed it in. Answer right away. So it's really tough to develop AI. It's a lot tougher than people realize. We have these great products, and we think, wow, this is amazing. What these services can actually do is pretty incredible. But if you're trying to do it in-house in a walled environment, if Bloomberg can't do it with all their resources, and it's obviously critical to them, if they're having a slow ramp up, then I wonder about any of the other people that are also trying to do it.
I've been wondering the same thing. Where is my Bloomberg GPT? Why am I still typing in like WEI or like all these antiquated functions to get to what I want? So it's hard. I guess
it's really hard to do. Yeah.
So where does Shopify fit in that? We've got a question on Shopify. It's a volatile stock. I actually haven't taken a look at it recently. Let's just take a look at how it's done. So it's run up and then it's pulled back in 2026 because nobody cares about tech anymore.
It's an interesting, obviously great company, great Canadian success story. One of the challenges with a growth stock like Shopify that is actually in more than one market, it's diversifying into all sorts of things, right? It's not just building people's websites anymore. It's also got the checkout, It's lending them money, it's doing all these other things. One of the challenges is that when you have a platform, you can always go off in new directions. You can create new products on the platform you have, and they definitely have an in with small businesses, and people love to use their service. So the question longer term is, who owns the end customer? Do I get a piece of the end customer, or do I have to pay it to the people who bring me the customer, to Amazon or to whoever's serving me up the customer? So as we develop new AI tools, Shopify has made the argument that the future of commerce is going to be what they call agentic shopping, which is basically you're going to hire a computer to go get you the best rates on hotels or shoes or whatever you're buying. It's going to put together options for you, serve it up to you in a basket, and then you're going to click yes, 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 and then you'll check out and buy it. So Shopify could handle the checkout part of that. Google could handle the putting together the options. Amazon could have its product lines, services put into that process. But who takes what piece and how much? And at the end of the day, is that how the consumer wants to shop? Remember, we were all going to buy things on VR glasses a few years ago? Well, it really does depend on human behavior and whether that's how they actually want to shop. Do they want to make their own decisions? Do they trust an agent to not be selling them to somebody else?
I think that's the hill I'm going to die on. Is I don't think VR will ever take off.
Yeah, that one's okay. We can probably say nobody here is wearing VR glasses.
Nobody here is wearing. Yeah. I don't think it's going to take off. Stop trying to make.
But that happened with Meta, for example.
Yeah.
Meta was going to go all in on the virtual world, and then they realized this is going to be very expensive and nobody wants it. Now we're all in on AI, which people apparently do want.
Yeah.
So with Shopify, that's the question, is how much of the business are they going to get? What's the eventual growth rate? It's priced to grow kind of 25% for the next 25 years or 10 years. I'll say 10 years, 25%. That's a fair value for the current price. And it's quite possible it does grow at 25%. But one of the challenges with growth stocks is that if the growth ever decelerates, and you can see that quarter to quarter, if you don't come in at 25, but you come in at 18 and a quarter, the stock gets hammered. And so are you willing to ride out that volatility is a good question as an investor. Do you fundamentally believe that it's a faster grower than maybe what the market believes? That's another time to get in, because if it grows faster than what people expect, multiple will go higher and you'll get the additional growth. It's a double win. But I'll tell you, our approach to Shopify this year is effectively we are short Shopify with what I call a collar. So we have bought a call a couple percent above market. So if Shopify goes up, we own a right to sell it at to buy shares at that price to close our short position. Right. So the call allows us to buy the shares. If they go up 3%, we can buy shares, close our short position. We've limited our loss to 3%. If it goes down, we have written a put at 15% below. So we are then required to, we receive shares at that put price to close our short. So effectively, we're going to participate if Shopify is between minus 15 and plus 3. We participate short and we get cash from shorting it. So the cost of the options is actually, to us, is very minimal.
But you're shorting it because you think that there's a chance that it's a growth stock, there's a chance it misses, and so that's where we could see it
effectively, we are bearish on the possibility of maintaining the multiple where it is, and also on the end consumer holding up as well as the end consumer has. But I will say, obviously we hedged on this bet. It's not a straight short, and the mechanics of what we've done mean that our break even is at plus 30%. So as long as Shopify doesn't go up more than 30% this year, we will make money on this position.
Okay, so a cautious short.
Yeah, but it's also it's a risk, almost risk-free to us because 30% we can always cover as well. We can cover the short position at 30%.
I know I made you talk about so many stocks, and I just want to squeeze in one more before we get to your pro picks, which is Rogers. It reports this week, and I think Canadians love their telcos. They've been a bit of a heartbreaker in certain areas. Rogers is going to report. We've got a question on Rogers specifically. Didn't have the same dividend challenges. It's been on quite an acquisition spree. But then there are things out of its control like immigration, and just kind of a slow growth, muddy environment. What do you do with the Rogers?
Yeah, that's a tough one because we liked Rogers when no one else liked it. It hadn't cleaned up the balance sheet yet. It was doing all these deals to kind of sell off the cell towers and do things to clean up the balance sheet. And we argued that at that time it had a huge discount to peers such as BC and TELUS. We found that BC and TELUS were stretched on their dividends. That was a big thesis from last year. So we looked at Rogers, said, great free cash flow. They're going to use that to pay down debt. People hate it. That's why it's so cheap. But if they do what they need to do to clean up the balance sheet, they'll get back towards a multiple that the peers have and great returns. And that was the recipe for last year. And then we, obviously benefited when the Jays did very well and people went, oh my God, they've got these media properties that are probably worth way more than people are giving them credit for. But I think that a lot of that is in the stock now. I still see a discounted valuation, so we still hold some, but we've reduced our exposure to telcos overall. And Rogers is we trimmed back a little bit on Rogers, but at $50 and below, it's still good value. It's probably maybe 10% undervalued there.
Are you dabbling at all in any of the other, to use the word, hated telcos?
We have some Quebec core.
That's not hated.
Yeah, it's not hated, and it's another one that's generating some free cash, and we like the growth. It has a bit of a growthier profile than some of the other names because obviously they're the entrant versus the incumbents.
Okay.
BC and TELUS we're still a little bit negative on.
Okay.
In fact, we're short, I think. We were short TELUS and BC at various points last year.
Because of?
Well, it matches up as a short against Rogers, first of all. And also we thought that the stocks were going to come under some pressure based on this view that, hey, if the top line isn't growing that well, we have to start worrying about dividend growth. And that's been a big thesis for people to own these names.
And of course, BC cut the dividend. Question is, does TELUS do the same?
I'm not sure that TELUS needs to cut as much as BCE did, but it could, in theory. They're looking at kind of some asset sales maybe to clean up a little bit, but they're probably in better shape than BCE was when they cut theirs. But yeah, there's some questions on both those names, and if they execute, they could do well. But right now, we're out of those.
Okay, we've got your highest conviction ideas. Let's get into it in Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into your pro picks. These are 3 high conviction ideas that you own in the portfolio. The first one is WSP Global, Canadian engineering and consulting firm, and I don't feel like it's definitely not a household name. Canadian investors know about it, but I don't know that it gets the credit that it deserves from becoming this little Montreal engineering consulting firm to this multi-billion-dollar global company in a very short period of time.
Yeah, I think it's an interesting story because in its early days, it had some accounting things and it was a small company, and small companies tend to have a little bit harder time kind of writing the financials and getting everything out. But then it started to develop and change its name to WSP Global. And it's a platform company that buys other engineering consulting firms. So one of the advantages to doing that is that you can get scale. If a client comes to you to do work on pipes, well, we also do work on these types of pipes. And we do work on nuclear. We do work on all these other categories. So there's synergies from having all of these different types of consulting under one roof. And it's also an industry where a small consulting firm can do very well with maybe 10 or 12 engineers, but they can't necessarily make the leap in management to become a 50 or 100 person engineering firm. So it's an opportunity to, again, buy private, where you can buy these engineering consulting firms private and get a public valuation, and also get some diversification of your product lines and of your consulting business. So it took a lot of consulting companies took a bit of a step back as the Musk chainsaw fell on government spending. But what we're finding is that long term, if you want to build something, and infrastructure build out is a real phenomenon globally, you need engineers, you need engineering consulting. So it's still a nice business that's growing at a relatively decent clip. And they're able to go and buy companies, and usually when they buy, it's accretive to earnings. There tends to be a period where it sort of slows a little bit right after a bigger acquisition, and now we're into a position where they're likely to grow faster than I think the market expects, and that's really what we go for.
It does better than its industrial peers. It hasn't done as well as the TSX, and over the last year, it's only up 3%.
Yes, and obviously, if you were only picking not popular names, then we would have nothing to pick. I mean, this brings me back, and we kind of use a particular approach when we're thinking about stocks. So how do you find something that's undervalued? And what I call the roll forward is important. So if I look at earnings 2 years out, what am I paying for those earnings? So if I'm paying, for example, 12 times earnings 2 years from now, and I know that the stock typically trades at 14 times forward earnings, if those earnings 2 years from now are maintained and we go ahead, we move the clock ahead 1 year, and the market next fall starts to look out to the following year, it's likely to pay 14 times. So I've paid 12 times what the 27 earnings are, and I've received 14. That is a source, it turns out, of a lot of great returns. We're looking for cases where they can beat the earnings, and where the roll forward of the multiple is likely to expand. And the opposite is true as well, as if the multiple is likely to contract. If I'm paying 14, it's likely to go back to 12, which it's averaged over the last couple of years. There's a lot more risk to my investment.
And they just did an acquisition that gives them bigger exposure to U.S. power and the power grid.
Yes.
Does that become a meaningful driver? Is like everybody's talking about that right now?
Well, there's definitely, they say accretive right away. So that's obviously good. I mean, accretion, just for the layman, is basically your earnings per share go up from the deal. And that can happen a lot of ways. If I find out something entirely with debt, it tends to be accretive because all of the asset comes to you. You pay interest on the debt, but then I get all the earnings back to equity. So that's generally how accretion happens, is that you finance it with some debt. But in this case, there's some synergies right off the bat. And some, cost synergies, not to use the euphemism synergies, but oftentimes it's duplicative overhead. So you're going to cut staff, or you're going to integrate staff. That happens when companies are acquired. But that's a source of why this is accretive right off.
Okay, so facing attractive markets and undervalued. Let's talk about GE Healthcare, which is your second pick, a spin out of the GE conglomerate, which is now 3 separate companies.
Yep.
Also a laggard, right? Down about 9%, underperforming the market. What do you see here?
Yeah, so we bought some GE last year in the middle of the year. Basically, there's some negative overhead here because of tariff risk, because of China, that really dragged down the stock. So people were worried. They eventually did make an arrangement where they're going to continue to sell in China, but through a third party. The Chinese market is a tough market to sell into. But these are a globally competitive brand. They're only a few competitors that do CAT scans, MRIs, all these machines that they make, Siemens, Philips. So they have a big market share. But really what we like about the stock is the fact that it's not hugely valued. And effectively, there's an opportunity here in this particular market to pair software and AI with the underlying hardware. And that can be extremely lucrative. If you think when you go in for a scan, you have a radiologist, high cost labor. Well, it turns out that AI can do a very good job on radiology. And so if you combine the software, the AI software, with the hardware, suddenly you can sell a whole new generation of these scanners that have software as a service built into them at a higher margin. So this is something that GE Healthcare has recognized. They went and bought a Montreal-based company called Intelerad that packages together all of that AI software. And I think that's a long-term trend, but ultimately we think that undervalued, it's probably worth into the 90s. You're getting it around $80. So it's a good healthcare option.
Secret AI stock.
Yeah, more or less.
What about Brookfield Infrastructure? Can we call that a secret AI stock?
Well, they do have a lot of exposure to the build out of data centers and the utilities thereof. But all of their divisions are growing, actually. And what you're getting with Brookfield is kind of a growthier version of utilities. You get a nice yield, top line, or the free cash flow, what they call funds flow per share is growing up to 9% a year. So you're getting an underlying dividend yield, I think around 5% plus a lot of growth, and not a lot of risk. And it's a well-managed company. So,
you know, when you go into restaurants and they have the like grades the restaurant has passed and it's like an A or whatever, can we apply that? Because you know more about accounting than I think I ever will. People always talk accounting and Brookfield. Just don't go in the weeds with me. Just give me the grade level.
So Brookfield Infrastructure probably has the cleanest accounting of the Brookfield group. Well, let's put it that way. And that the Veritas research analyst, that's his one buy in the Brookfield space. They don't like renewables. They don't like asset management. They don't like Brookfield Corporation, BN. And that's a lot of that comes down to how the intercorporate arrangements are set up. But Brookfield's relatively clean. It's a group of assets. The assets are fairly transparent. We know you know what you're getting. And there's been a lot of capital directed to them that they can invest. And ultimately, I think that's the secret that Brookfield has that makes the secret sauce is that people are willing to give them capital as they can drink from the fire hose of capital from institutional money at very low rates. They're very good at reinvesting from those low rates and earning a return above their cost of capital. That's the secret. But it's a reputational secret because as long as people want to direct to those type of assets, so as long as they want to give you money, then you can get that low cost. But I think our argument has been on the other side of the businesses is that there's more inherent risk tied in with the underlying than people realize. There's private equity exposures, private debt exposures. There's all these things that are relatively opaque. And U.S. peers that do much the same thing don't have nearly the valuation that Brookfield, the main Brookfield.
But that doesn't apply to Brookfield Infrastructure.
No, Brookfield Infrastructure is a nice set of assets with predictable outlook that's growing, good dividend yield, and that's why we like it.
So it's funny, when we started this podcast, Sam sat down, he's like, well, I don't know if I can go an hour. I think we've answered that question.
Okay.
Thank you so much, Sam. It's been an absolute pleasure to hear how you think about stocks, and probably people learned a lot about stocks that are in their portfolio. They never even knew the nuance. So thank you so much.
Well, thanks for having me.
That's Sam LaBell joining us from Veritas. Don't miss our next episode. We've got Michael Green on the show. He's known as kind of like a macro thinker. He's a portfolio manager and strategist, chief strategist at Simplify Asset Management. So if you've got any big picture questions, you can email questions@inthemoneypod.com, and we'll see you on the next episode.